Mike.
Thanks so much, Erica, and I appreciate you guys taking the time out of your busy days to talk to us about life insurance and long-term care. There's a variety of ways to carve each of these various subjects up, and so today our main objective for you all is to kind of introduce you to the various types, how they work, where they work, and why they might work in your case scenario. So again, lots of different ways, again, to carve a lot of these different things up for each and every one of you. Life insurance, again, is one of those benefits typically that you don't always get necessarily for yourself, but you get it for your family. It's going to be there when you pass away to be able to take care of unexpected cost. It could be burial, it could be paying off credit cards, house, variety of things, or maybe just in order to keep the estate intact for those future heirs. Life insurance has a variety of vocab around it. Term insurance is one that most of you have probably heard of. We also have universal life, guaranteed universal life, also known as GUL, variable universal life, indexed type policies, joint policies where husband and wife may be on the same policy together, whole life, children's policies, and then we'll talk about a couple of different benefits and how somebody would go about underwriting for these types of policies as well. So a question that comes up very, very frequently when we're sitting down with folks talking about holistic planning is what is the best type? And at the end of the day, and you're going to see this, there is really no best type. At the end of the day, they're all going to pay out the exact same to your heirs as long as you have them the day you die. And so ultimately, again, we kind of kid around, but you tell us when you're going to pass away, and we would help construct the exact policy that's going to fit your needs. But again, each one of these does have different caveats, different advantages, and also disadvantages. And so we'll explore several of those here in this case scenario. The first one that we see that most people have, and we see this more and more probably as a trend in the last 20 years, but if people don't get things through their employer, whether it's a retirement plan or health insurance or other things, oftentimes it's harder for them to obtain. And so a lot of employers put together what's called a group term policy. And term insurance in its short note is a type of plan that would cover you for a specific period of time. And so group term covers you as long as you're typically employed by your employer. They're very, very simple. They're very inexpensive. And it's a guaranteed issue type of a plan. So there's no proof of insurability. Typically, there's no medical questions. It's just check a box. Do we want the coverage? And again, it would cover you for a set dollar amount. Oftentimes, these may be a flat dollar amount, same for all employees, 25, 50,000, et cetera, or maybe a one-time compensation or two and a half. Each company provides different types of benefits. But the nice thing about the group term policy is it's a benefit that typically is provided by your employer and covers you for your employment terms. Some companies allow buy-up options. So you might have, again, your base policy, and then maybe they will allow you to buy up an additional 50 or 100,000 without a proof of insurability. This is a tremendous benefit for somebody that may be uninsurable elsewhere. You have a medical condition, a variety of things on that front. But again, that would be some of the advantages on this group term outlet. If an employee leaves the employer, I mentioned typically there's an expiration, and that's at the quote termination of employment. Some of these policies will allow you to convert them and take them on as permanent policies. However, it is extremely expensive. The people where we do see that implemented, I'm going to say 99.5% of the time it's not taken on, post-employment. But the times that you want to take advantage of it is if we know we have a terminal illness or a medical condition, where at least you, again, want to be able to take part of that policy with you for your heirs. Moving on the term insurance route. So we talked about group term insurance. The next kind of phase on term insurance would be term insurance that you would get on your own outside of your employer. And through just general term insurance, again, this is going to be I use the analogy a lot like car insurance. You buy it, you hope you never use it, you pay a premium on it, and at the end of the time or whatever length is that we lock in, that policy essentially is expired and then we have to renew once again. Term insurance, again, is cheap insurance. Less than 3% of policies typically ever pay out because people don't die within that term window. On that particular type, again, when I'm talking about a specific term, it could be a 5-year window, a 10-year window. Very commonly, we'll see 20 or 30-year term. And term insurance makes a lot of sense for somebody that has a specific insurance need or something they need to cover. For example, young children, if somebody passed away, we want to make sure the family's taking care of the mortgage. It allows you to buy a bigger policy for a lot less premium. But again, the downside is after that policy expiration, at that particular point in time, normally we're going to have to go out, we're going to have to prove insurability again and get a new policy, which is going to be substantially more expensive than what we had when maybe we were younger. Some of these policies we're going to explore would allow you a conversion option. It's almost like insurance on your insurance. So you pay maybe a 10% more in premium, but it allows you a capability in the future to be able to transfer this term into a policy that will be with you maybe for the rest of your life, a more permanent oriented policy without proof of insurability. Down below in my example, again, it kind of gives you an idea of maybe for a 30-year-old male and female, a 40-year-old male and female, general idea of what cost structure for these types of policies may look like. At the very top, that gives you an example of somebody that may come back at a standard rate. And what happens is the underwriters would take a look at somebody's previous medical history. They would do blood and urine exams, a few things along those lines. And they'd say either you're better than normal, maybe you're subpar, or in some cases you may be uninsurable. But obviously, the healthier you are, height, weight are factors that come into play as well. The cheaper the insurance company looks at, we can insure you for a lesser amount. Again, because the odds of you passing away are going to be very low in their eyes. But that is kind of, again, giving you a quick sample of what those would look like. If you are a smoker or non-smoker, let's say smoker, for example, typically there's going to be smoker rates. Some insurance carriers, if you use chewing tobacco or let's say you smoke a pipe versus smoking cigarettes, some companies will say, that's okay, we're going to give you a non-smoker rate, but there's a little bit more underwriting that comes into play. So it's not always a one-size-fits-all, but each carrier looks a little bit different in those operations. We talked a little bit about this conversion option a minute ago, but again, it just allows you to maintain your health rating for that term policy. And you can decide how much you want to convert. So if your term policy was $500,000, but you can't quite afford that more permanent outlet, maybe they convert 250 of that 500 and let the other 250 expire. When it converts, again, it does go typically to a, let's call it a universal life or a whole life type chassis. And we're going to, again, explore what that means. But a lot of these policies, they do accumulate some cash value, and that's to help offset future costs to where the premium, even though it's going to be higher, it's going to be more levelized and we don't run the risk of the policy expiring on us. Universal life has become a lot more popular over the years. Traditionally, universal life is a permanent type of plan, and it does accumulate cash values. What people typically like about universal life is it is known as a flexible premium type of a plan. And so as we talk about flexible premium, the insurance company has a target premium level. And that target premium is kind of what they say we should pay on our policy. Some people would pay more on their policy saying, I'd rather pay more, allow it to accumulate cash, and maybe have it be paid up in 20, 25, or 30 years or something like that. And so they could pay up their policy early, and maybe by the time they hit retirement, they don't have that extra expense in their retirement years. The other flip side of that coin is there's, as we said, a max that you could put in, but there may also be a minimum threshold in order to keep the policy in force. And so based on somebody's circumstances, if they get into a financial bind, it would allow you some flexibility to where maybe you could cut back your premium, or if we've got enough cash inside the policy, we could even skip premiums in future years and then make those up in years thereafter. The cash that is inside those policies, we can kind of see option A and option B, but the underlying cash value is tied to interest rates. Interest rates right now are low. So the illustrations that we're seeing in the grand scheme of things is if interest rates start rising, what that could mean is maybe we don't have to pay as much on our policies in future years. The option A type, I'm going to just hit this very briefly. It's more of a levelized death benefit in these universal plans. And the insurance agent, along with the insured, would make a decision what features maybe they like within these policies. Option A says maybe they lock into a $250,000 death benefit. We can see that flat line. And then in the future, maybe 30 years down the road, if we've got enough cash where it's pushing our death benefit, maybe in the future it begins pushing our death benefit higher, but the intent is for it to stay fairly level. That also somewhat cuts back the expense. Option B on the far right-hand side is an election that says, as I make my cash or my premium payments, my cash continues to accumulate each and every year. And so if I buy a $250,000 policy, but maybe my cash value has grown to $20,000, my death benefit, I still wanted my death benefit to be at, let's say, that $250,000 spread. So it would in fact show $270,000 in my example. So as the cash grows, the death benefit grows each and every year. On out there in the future, this could become a little bit more cost effective or more costly, I guess you would say. And sometimes in the future, what somebody would do is make an election to convert from maybe an option B where it grows over time. Maybe they then turn it into a flatline policy at that particular point. But there is no expiration date, and these policies, again, do accumulate cash value, and that is in a tax-favored manner. The cash grows tax-free, and it does provide all of these permanent policies that have cash. It does typically provide cash outlets where somebody could borrow money from their policy. And really what you're doing is you're borrowing the money from yourself. So in that same $250,000 death benefit example, if there were $20,000 in cash and I borrowed, let's say, out $10,000, they would just reduce my death benefit if something happened to me at that particular point in time. So my heirs would get a little bit less. Universal life policies, as we mentioned, are essentially that cash is, again, driven by where interest rates are. What we've seen, and it's important to maybe look at doing a policy audit if you have had or you maybe took out an insurance policy back in the 80s. Back in the 80s, as many of you know, interest rates were very high. In fact, they were double digits. And so these universal life policies, their projections were based on these double-digit returns because of where interest rates were. Well, we know what's happened over the last 30 or 40 years is interest rates have fallen substantially. So the problem you can see in this bottom left corner is our cash maybe in those early years started accumulating, but when interest rates started falling off, unless we increased the amount that we were paying in our premium, all of a sudden our cash value started falling. This is potentially very, very dangerous. And in essence, if that cash value drops all the way down to zero, the policy will lapse, which means all of a sudden the death benefit we thought we were going to have for our families is no more. A way to fix these types of plans, once you look at, again, if this is a danger or not, is the premium could be increased to put it right back on the correct trajectory. Again, we want this cash to at least continue to accumulate for us, not go that opposite direction. The secondary scenario that oftentimes we'll explore, especially if somebody is healthy, is looking at what's called a 1035 exchange. And that just means that we take the existing policy, the one that maybe was issued 20 or 30 years ago. And we take a look at where our cash was, and we basically move that cash over into a new policy. And we don't do that until we know the new policy is going to be a better situation. But with this 1035 exchange, there's no tax consequence. And ideally, maybe we are paying the same amount of premium as we originally thought, or we don't have a premium to pay at all. So the positive by doing this exchange is, again, a new policy under new mortality tables. People are living a lot longer nowadays, so the cost of insurance is lower. Again, getting it back on track to where it should be. And sometimes, again, this 1035 exchange would make more sense than trying to save a policy maybe that's broken or has that older mortality or higher insurance costs. Guaranteed universal life. So we talked about term life before. We talked about universal. This GUL, or guaranteed universal life, is almost like, I'm going to say, a hybrid of the two, or a life term type of a scenario, where somebody comes to us and says, you know what, the ideal term that I want is I want it to guarantee that it's going to be there the day that I die. And under this particular election, the insurance company says, if you pay X premium, we will guarantee that it will be there until a certain date. And normally it's a specific age, maybe 95, maybe age 100. Some of these policies now even go all the way out to age 120 because of the longevity factor that we have. Again, premiums are guaranteed. So this isn't where we have kind of that flexibility like we had in that previous policy. It's a fixed death benefit. And again, we have limited or no cash value within these types of policies. Variable universal life is, again, another permanently oriented type of a plan. The main difference, instead of it being tied to interest rates, variable kind of gives us away, and the cash value would be invested in underlying indexes or the stock market. So for somebody that says, you know what, I'd rather take a little bit more risk, I like the tax-free accumulation factor, and sometimes people will use this or say, hey, this is a supercharged Roth, which again, we have insurance costs, so I don't completely agree to that avenue, but it does allow my cash value to accumulate tax-free and still be invested in the stock market. And we have this ancillary death benefit that would go out to our participants. We still have the same flexibility to be able to borrow from our cash values. The potential danger in this type of policy is if somebody gets out there into their retirement years and they don't relook at the underlying portfolio, so they don't understand the amount of risk, that could become very problematic if markets turn south like we saw in March of last year. So again, it's important, just like your 401k or IRAs, to understand what it is that you own inside of our insurance vehicle, to be able to make changes based on your life and based on your risk tolerance. Index universal life policies, and I know I'm giving you the alphabet soup here, but these are becoming very, very popular because they have a ceiling and floor. So they're like a variable life policy. It's just instead of markets, if they go up 40%, the variable policy will be up 40%. This type of policy, it would have a specific cap rate. And so maybe if the market was up 40, at the very bottom here, it says cap rate sample, maybe our policy is capped at 10% or 12%. But the other advantage is on the downside, if the market pulls back 30%, we're not down 30%, it has a floor that says we can never go below zero. And so this cash value accumulates tax-free. And again, it's not tied to interest rates, it's tied to the indexes, but we're going to be somewhere in the return between maybe a 10% and a 0% year-over-year return. So that's a little bit on the index type of a strategy. Joint policies. A lot of people aren't familiar with these because traditionally when we think life insurance, maybe we've got mom and dad, and so each one has their own policy. If mom dies, it would pay out to the estate or pay out to dad or the kids. A joint policy allows me to take two lives, okay? And maybe again, this is mom and dad, and they're all underneath one policy. And my first example is a first to die policy. The first death, upon that first death is when the insurance policy would pay out. And so the survivor would then get those proceeds. Upon the second death, the policy's already gone. It paid out on the first life, the first death. And so sometimes these policies are going to be a little bit cheaper because, again, we've got two different insureds. The joint last to die, we use a lot of times for estate planning cases. And it says that it would pay out on the second death. And historically, again, depending on where estate taxes are, the second death is when estate taxation is due. And so again, it allows us to take two insureds and put one policy in place. These could be a term or permanent oriented policies. A lot of times we use that guaranteed death benefit scenario. And again, can have potentially lower premiums. And it's just something that you would have to look at those scenarios to determine which policy structure is going to be best based on the objectives of the family and the estate. Whole life has been around probably the longest of any of these. It is a permanent oriented policy and the premiums remain the same. So I don't necessarily have that same flexibility that we have in our universal, but it's got a higher premium that we would pay than typically those other policies. But we get tax-free accumulation, and over the long haul, the cash accumulation, it's more subject to the insured kind of, I guess what you could say, how they keep their financial books. It's going to normally be invested with that insurance company, you could say, but they do have a guaranteed return on those policies. A lot of older policies we see, maybe that were issued, let's say 40 years ago, kids policies, a lot of times typically are going to be whole life oriented. They're healthy policies. They're just going to be a little bit more expensive, and the death benefit in those early years may not be as high as those other alternatives. Children's policies. Children's policies, let's say you've got a family, you've got 3 or 4 kids, cash flow's tight. If a parent was to get a policy, a lot of times we will add maybe a children's rider. You can see that in the very bottom of this slide. One quote, let's say children's rider premium would typically cover all children to the age of 21. In some cases, it's 18, so you need to double check with the insurer. 4 kids, normally it's pennies on the dollar for cost. I mean, it's very, very inexpensive to do, especially for the rider. But parents sometimes will go off and get individual policies for those kids. And a lot of times we actually see grandparents come in and do this. They're not major policies, but those policies, maybe again, you get them a $50,000 or $100,000 policy. Cost is low, it accumulates in cash. And so in the future, if there's ever an issue with insurability, at least we were able to get something on them earlier. And some of these policies will allow for future buy-up opportunities without proof of insurability. Benefits of the variety of these life insurance policies, again, cash value is going to accumulate tax-free. Money, we have the ability to borrow from the cash values. And again, the key on if we borrow it, again, we just want to make sure we're paying the interest back. And normally the interest is going back to yourself within that policy. The insurance company works on about a 1% spread. They keep about 1%, they'll credit you the difference. Generally, the death benefit, again, is paid out to the beneficiary untaxed. And again, we can, unlike 401ks or IRAs where your spouse has to be the primary beneficiary or they have to sign a waiver, life insurance, you can list anybody as your beneficiary. Getting a little bit off track, but if you're looking at estate planning and you want to leave money to charity, we typically do not recommend leaving a life insurance policy to charity because, again, your life insurance, we'd rather see that maybe go to the family where, again, it's a tax-free benefit. If you want to leave monies to your charity, maybe you're looking then at your pre-tax IRA or your 401k. Charities don't pay tax, and so that would be maybe a better outlet to leave to them than leave to your families because it would be subject to tax in that situation on those pre-tax monies. Life insurance is subject to underwriting. And so the question always comes up, what does that entail? What does it mean? What does it cost? And underwriting, when you're kind of kicking the tires to determine what type of policy, what's the cost structure going to look like, there would be a formal application. The insurance company is going to take a look at your medical records. They're going to contact, again, your doctors, and they'll take a look at doing a blood and urine depending upon the level of insurance that you're looking at getting. They do look at your motor vehicle reports, and they'll take things into consideration such as hazardous activities. Are you a skydiver? Do you scuba dive? How many times a year do you do these types of events? They then will come back to the agent and the insured with an offer. And so they say, okay, based on all of our tables, et cetera, your policy, your premium would be X. And the insured doesn't have to accept that. At that point, we can say, you know what, we like or we don't like. And so if we want to make modifications, we can say, well, instead of the, let's say, $600,000 policy, maybe I only want $400,000. So I could reduce the death benefit a little bit. I could modify what we want to do. And ultimately, we take that back to the insurance company. They say, yes, that sounds good. And then they would then issue the policy, and we would be able to kind of set up the premiums for those policies. But just because you go through the underwriting process, there's no commitment that you have to make that says you are going to do a policy. You have that capability to completely walk away if it's not the right fit for you, or would find out that there's an issue. Before I move on and turn it over to Angie, I just wanted to really quickly check to see if there was any specific questions on the life insurance that we discussed. We are going to talk about some other hybrid type plans revolving around long-term care type vehicles. But if there are not, I'm going to go ahead and turn this over to Angie Hughes. Angie is with Producers XL. We have worked with her team and group for probably 15 to 20 years now. And she helps us, as we have cases, construct the case design around what we're trying to accomplish, determine what company or carrier might be the best fit, and has been a tremendous asset to our team. So Angie, I appreciate you joining us on this, and I am going to turn it over to you.
Great, thank you, Mike. I wanted to first start off by saying that I loved all of that great information when it came to life insurance, because as you were speaking, Mike, I kind of went into, long-term care insurance, as I'm sure all of you are sitting here on this call, are probably thinking, wow, how is she going to make this an interesting topic? Because the words long-term care or long-term care insurance most certainly do not conjure up favorable images, I would say, to us. But as Mike said earlier, life insurance is for your family. And I would say to you, long-term care insurance or extended care planning is also for your family. Because when we start talking about when care would be needed, the good news is you're still here. You're still on the earth. Your family is still a part of your life. And so it's something that we have to kind of put a plan in place. You work with Mike's team because it's going to be important to know what is the right plan. And we've got a one-page sample document that basically walks you through, and we're very fortunate that there was a little thing that was passed called the Pension Protection Act. And what it did was it gave us, the good news, gave us lots of options when it came to making extended care planning. However, kind of the downside of that is you have a lot of options. So to make this very busy one piece of paper very simplified for you, I'm going to break it down and kind of start over, if you will, on the far side under the self-funding. So if you don't have a long-term care insurance policy, a short-term care insurance policy, a life-based contract, something with a long-term care rider on it, I would tell you that you are in the category of self-funding your extended care needs. So I think if we all think forward to living our lives the way we are today, we're active, we're either working still, we're kind of looking forward. I know I've got a 22-year-old daughter that's just about ready to graduate from dental hygiene school, so I'm thinking pay raises in my very near future with no more tuition due. And so the idea behind that is I'm going to kind of stop looking in my rearview mirror and start looking forward to, right, the wealth accumulation, and to really start packing things away for me and my husband. And one of the things that I don't want to do is have the misfortune of all of a sudden not having a plan in place and having to spend all of the money that I've worked hard to accumulate just to pay for care for me or my spouse, whichever one of us might need care at some point in our lives. So we're working, we're vibrant, we're doing our things, we're traveling, and I'm kind of air quoting that, if you will, because we'll get back there someday. We certainly will. So without any type of insurance policy in place, you are self-funding that risk. And insurance in its basic format is nothing more than a transfer of a catastrophic risk to an insurance company. You pay pennies on the dollar, a premium, to get back a lot of coverage. Think of that in terms of your homeowner's insurance. You pay a monthly or an annual premium for that, so that if your house burns to the ground, you would have somebody to come back in and be able to replace that home and the furnishings that you have in it. If the house never burns to the ground, then you're not going to collect that big replacement policy. Self-funding is the same strategy. You're basically saying to yourself, look, if I don't ever need long-term care, or I never need some extended care, I never need someone to come into my home and provide me with home health care, if I never need anybody to come, if I don't have to move to an assisted living or, heaven forbid, into a nursing home facility, then you win. You never paid a premium for insurance that you didn't otherwise need. And quite frankly, I think everybody buys long-term care insurance with the intent that they never have to use it. At least when I bought my policy 10 years ago, that was exactly my strategy. I bought it just in case. We have the one daughter. We didn't want her responsible for figuring out how to provide care, hiring and firing, all of that. So we just put a plan in place that said, look, kiddo, if something happens, here's the paperwork. You call the insurance company, they'll help you. So if I come back to the far left-hand side of that and we look at what's called just long-term care insurance, that was the first strategy that we ever had to us. So those are your traditional contracts, the old generational products that, I guess, if you will, that your parents, your grandparents had, if they had any. It's not, the long-term care industry space is not nearly as old as life insurance. Life insurance has been around for a very, very long time, if not a century, right? At least 100 years. Long-term care insurance, between 40 and 45 years. So it's an evolving space. So we do have policies right now today that are going through some repricing and different models, and they're coming out with new generations of that. So it's not necessarily the old school that we've seen in the past. I've been doing this for over 20 years, and we've seen a wonderful evolution of those contracts. I will tell you, one of the things that gets an awful lot of attention today is the middle two columns there. The one that's called the asset-based hybrid and the one that's called the life insurance. Both of those solutions are life insurance based. So take everything that Mike just talked about with regards to life insurance and now slap a long-term care rider on the back end of that says, oh, by the way, if I don't need to access my life insurance, but I do have a long-term care event, can that be a source that I can tap into, pull income from that policy, that life insurance contract, and pay for my care? So really what you're doing is nothing more than accelerating that death benefit for long-term care services. So those are very attractive features right now. That's also where you get a lot of differences in the contracts. So an asset-based, I want you to think of that in terms as a lump sum. You've got CD money, money market account, basically lazy money that's sitting out there that you're not otherwise necessarily earmarking for anything, but that makes a good reposition. So we like to, in my little world, we like to say, we're just going to reposition the money from your left pocket to your right pocket, and we'll leverage that dollar inside of there for long-term care events if you were to need that. Typically, they're on a single premium type chassis. I also have some of those contracts. Mike talked about the joint life, where you can actually insure two people. The reason why life insurance contracts are attractive today is because, one, we can guarantee the premiums on them. And two, because a lot of folks feel like, hey, I know in my lifetime that there's 100% chance that I'm not going to live forever. I'm going to die at some point in my life. So the idea is if I live and need long-term care, I'll tap that money out of my life insurance. If I die and never need long-term care, then there's a death benefit that moves again, income tax-free back to my named beneficiary. And most of them, because they are sitting on either a whole life insurance chassis or a universal life chassis, there are cash surrender values. So if you wanted an exit strategy in that, you could walk away from the contract and take whatever surrender value, account values inside that policy as well, which is never going to be the collective amount that you've paid in premiums, but nonetheless, there's still somewhat of an exit strategy there. So that's kind of your asset based. The life insurance is a little different because you can do a monthly premium payment on that. Those are typically your smaller face amounts, the smaller death benefits. You want $100,000 of life insurance or $150,000 of life insurance. They're smaller death benefit amounts. And then all you're simply doing is accelerating it. There's really not a lot of smoke and mirrors when it comes to these type of contracts. You have a $100,000 death benefit and you accelerate 4%, it'll pay out $4,000 of long-term care, and 4,000 into 100,000 is 25. That'll pay 25 months of care for long-term care. So really very basic on how they work. The great thing in the opportunity with these, like Mike had mentioned, there's a little thing, an IRS rule that's called a 1035 exchange, which allows you to basically take monies from an old life insurance contract that you maybe no longer have need for. You bought it when the kids were young. It's a whole life. It's got cash value in it. You can 1035 those dollars over without it being a taxable event and move it into another contract that maybe has a long-term care rider on the back end. And so that allows you to find the funding, if you will, to pay the premiums for those types of contracts. So they are very popular right now. I will tell you that it's really a matter of having a conversation with you as to what works best for your family. I will tell you that life insurance opportunities with long-term care riders isn't always the least expensive. Mike touched upon underwriting for life insurance. We have to keep that in mind here as well, because traditional long-term care contracts underwrite what's called morbidity. So think of that in terms of not what's going to kill you, but basically what's going to land you in extended care. So when we think of those things, we think of, mobility issues, walkers, strokes, Parkinson's, MS, those types of major things are things that you can live Alzheimer's is another good example. You can live a very long life with those chronic conditions. They don't necessarily kill you instantly, like say, something that life insurance underwrites a little bit more heavily for on a mortality standpoint. So life insurance is going to look at things like cancers and heart attacks and things like that could be fatal. So the underwriting is a little different. When you put a long-term care rider on a life insurance contract, we now have to underwrite for both of those aspects. So we're going to underwrite for the morbidity and the mortality. And so sometimes the cost of insurance built inside these contracts is a little bit more. So it's really just a conversation as to what's going to work best for you and your family. When I slide over into the fixed or indexed annuity options, because interest rates aren't necessarily sky high, they're just not. These contracts aren't really the place where you go for the leverage in them. What they are attractive for, what really makes them sizzle, is if you've got a non-qualified annuity, because you are allowed to do the same 1035 exchange without that taxable event from one annuity to another annuity. You can move those funds over, and there are some annuity contracts with long-term care riders that say, hey, if you drop a chunk of change into this annuity, we're going to double or triple that value. So 100,000 turns into 200,000 or 300,000, depending on your health, which is a simplified underwriting process. You answer all the questions no, and then you qualify. That allows you, and here comes the sizzle to those, you can actually use the monies inside of those annuities, even though there's gain inside of them. You can pull the funds out to pay for long-term care expenses without without a taxable event. So that's what makes those contracts sizzle. Obviously, we see those being a little bit more attractive with our clients that are maybe, 68, 69 into their 70s, and they can still answer the health questions, because usually those are the folks that have held those non-qualified annuities for a period of time, and there is either some or some substantial gain inside of them. So that was an awful lot of information. And as you can see, there's a lot of pros and cons between each one of them. So it's really never a one size fits all. I will tell you, it's really just a conversation as to what's right for you and your family. And speaking with a lot of clients and consumers when it comes to long-term care insurance, it's just never really a very fun conversation, which is always interesting to me, because the long-term care good news is that you are still alive and you're here. You just need some assistance. And I know when I bought my long-term care policy, I walked into my house, it was at the dinner table. My daughter was way too young to understand this, but I was very excited to tell them, look, I have a plan in place. I don't want either one of you in the future to be my caregiver. So it was important for me to make sure that was in place. Whether, the life insurance based works best for you, or the traditional long-term care, or maybe even an annuity contract. It's really just having a conversation on what is the right solution. We certainly don't try to position one being the end all be all solution for everybody, because that's not always the case. So it's a matter of just looking at all the pros and cons, how they work. I will tell you that I never like to miss the opportunity that if you are a business owner, you do have some tax deductibility privileges when it comes to the traditional, so the far left-hand side. The long-term care insurance contracts do have some tax deductibility opportunities for the business owners. They become very deductible. The limit amount is very much applicable to the premium dollars when you get to about age 61. The deductible amount looks to be very close to, if not 100% of that premium can be deductible as a business expense. So there are some opportunities there, and I never want to miss that, to mention that, and if you have HSAs also, right? So there's dollars inside of your HSAs that you can accumulate if that's your health insurance route, that you can use those as a qualified expense out of your health savings account under your major medical health insurance. So lots of good things here. Obviously, lots of opportunities. Maybe it's making you think about some different things, like maybe we should explore this option, or I want to learn a little bit more about this. And that's exactly what your entire Converse team is there to do for you, is just kind of educate you on what's right for you, what's right for your family, and what would work when you really need the contract. So Mike, I'll open that back up to you.
No, Angie, that was great. And I guess a couple things that typically come up in conversations we have as we're looking at planning. And again, it's like life planning that we're looking at. What do we want the future to look like? Or maybe even more importantly, what do we not want it to look like? And so long-term care, again, is protecting the ones that are not going into the care, because again, one of the biggest concerns is how and where are we going to get this money? I think a lot of times as we sit down and we start exploring or having that conversation, maybe somebody's parents in care and they're seeing what it's doing to the estate. I think an important thing to think about for those of you on the call, when you're looking at potentially getting long-term care insurance, you don't have to fully insure these things. Average care right now in Kansas per day, what is that, Angie? I'm sure you have.
The median cost still sits at about $100 a day, $4,500 a month.
So $4,500 a month, and then a lot of it depends on if it's full care, what level of care, and sometimes people will say, okay, maybe I'm willing to self-insure $1,500 per month, but maybe I want to try to get insurance that's going to cover me for $3,000 of it. And so again, you can kind of construct or build these policies around how much, let's say you want to, again, self-insure, but offload at least a portion of it onto the insurance carrier to give you maybe better peace of mind. A lot of these plans, again, have that inflation protection rider. And I would tell you the care that we have seen, and I'm sure Angie would agree with me on this, but 20 years ago, people would get these long-term care policies and we would call them long and skinny. They would cover somebody for, if they went into a long-term care facility, it would cover them for 30 years and it would pay X dollars per month. Well, if you look at studies, the average care for whether it's assisted living, long-term care, et cetera, is under 3 years, or maybe right at 3 years. So what Angie does a great job of doing for us is constructing maybe shorter, fatter policies that would be kind of in that sweet spot for that care under 3 years. And Angie, do you want to talk maybe a little bit about that, maybe what we're seeing on shared care riders, just to kind of give them an idea of things in the industry right now?
Yeah, absolutely, Mike. And that was a really good point, because I will tell you, it's really important to understand that everything that we hold insurance on, we co-insure that risk. And long-term care is absolutely no different with that, because quite frankly, if you went into full-blown Alzheimer's care or memory care, I mean, you're talking upwards of $8,000 to $10,000 a month. Well, I don't know anybody that's buying policies that are that large. So there's absolutely no reason why you should be afraid of that. And we do see the policies being shorter duration, but bigger in a monthly benefit. Because think about this, a long-term care insurance contract is nothing more than a guaranteed income stream to pay for care when you need it. So all we're looking at is this big pool of money, if you will, this big bucket of money, and you can pull out of it on a monthly basis. And when we put shared care on there, we're basically saying, if I was to hold my fist, if you could see me, I'm holding one fist out and another fist out. And it basically says, if I use all of my benefits, I can cross the shared care bridge and I can start using my spouse's benefits. And you may say, well, gosh, you wouldn't want to use all of his benefits. And I'm not a big fan of necessarily statistically selling, but there was a survey done by CMS a while back that showed that it was like 52 or 54% of Americans are going to need some form of this type of assistance in their life. So the odds are 1 in 2, a wife or a spouse, but neither one of you typically are going to need 10 years of care, each. So there's nothing wrong with building these policies, because if you don't use that full monthly benefit, it's not a use it, lose it proposition. You've just extended the life of that contract, which is a good thing. So you're just holding it in the pool of money, in that bucket of money, to be used at a later date, which means it can stretch even farther. So shared care is a great way to extend benefits for couples. And we almost always, that's what we quote.
Angie, we had a question come up. What % of long-term care policies end up dispersing funds?
Oh, that's a great question. So the only way that we can really track that data is by people that hold long-term care policies. And I don't foresee this actually ever changing. 80% of the people on claim for long-term care insurance use those benefits for home health care. So understand the evolution of a home health care claim. Husband and wife live together. One of their kids may live in the area, or a good support group, or a close friend, whatever the case is. That home health care claim typically starts out very small. Incidental care. We take care of one another. So it's really an untrackable amount of time before all of a sudden the family has to cry uncle and say, we need some help. It's evolved into more than this. And then they hire an agency to come in. So if 80% of the people on claim with long-term care insurance policies are pulling benefits for home health care, kind of gives you the utilization of a long-term care contract is very high. And I'm going to change that question just a little bit, because people that buy long-term care insurance policies, less than 0.5% of those folks ever let the contract lapse. Now, been doing this for over 20 years. I've seen many contracts, older generations, go through premium rate increases. Those contracts are not lapsed. All they do is change their benefit structure inside that contract, because they've got movement there. There's levers you can pull to bring that premium back down in line, and then they continue with that contract on a forward go. And so we don't see a high lapse. And if I get real nerdy about this, when you go way back when they started pricing long-term care contracts, they thought they would have upwards of a 15% lapse rate meaning people would just stop paying the premiums and walk away from the contracts. That did not happen. People that buy these contracts have high utilization, and what we're seeing now, because we've obviously had 30, 40 years under our belt with this, we're starting to see folks actually use their policies sooner than later. And the largest growing claim area from a few years ago was assisted living, because you could actually take a husband and wife and they could move into the assisted living with one of them going on claim and the policy paying for that while they were still able to live together. They have their own door, their own apartment, all of that kind of stuff. But aging in place is what most folks want to do. And aging in place is nothing more than a fancy way of saying, leave me at home. And I think we can all relate to that. If you've ever had a surgery and been in the hospital, the first thing you want to do is get home. And
kind of a follow-up question, what does the cost structure for long-term care look like as individuals age? And is there a sweet spot on a certain age to purchase it?
Yeah, fantastic questions. I love this. So I'm going to give you a great ballpark for premiums, because everybody's unique. It's all based on age. It's based on your health. Obviously preferred health gets a better risk than a class 1 rate. So let me just ballpark very generically for you what premiums look like. And I'm going to kind of benchmark this between 60 and 65 years of age. Whatever you buy in a monthly benefit. So if you buy that $3,000 a month benefit, husband has $3,000, wife has $3,000. So it's going to pay in the first year $36,000 each. And then that benefit's going to grow at 3% compound over time if that's what you choose. The annual premium for each of you to get $3,000 a month in benefits would be about a $3,000 annual premium combined. $3,000 each a month is $3,000 annual combined premium. That is a very generic ballpark. That lever, obviously the premium gets a little higher as we get into, closer to age 70. The premium gets lower when you get under the age of 60. The sweet spot for buying this, I will tell you, I like to start talking to folks when they're in their 50s. Now, it depends on their family dynamics. Some people come to us much sooner because they're dealing with it in their family, and that's perfectly fine. The younger you are, the less the premium is going to be. But you'll pay for it over a longer period of time, but it should be at a lower premium rate. Most folks typically in their 50s, however, they still have kids in college, kids in high school, the mortgage that's getting close to being paid off. So we do see, and you'll hear, Dave Ramsey tells everybody, don't look at it until you're 60. But what you have to stay very aware of, the sweet spot is to buy it before you become uninsurable. And that sounds really silly, isn't that just anything that has an underwriting base to it? But the sooner, we're all just basically that one doctor's appointment away from really not being able to buy life insurance or buy long-term care insurance or make a proper plan that we need to have. So if you're healthy, that's fantastic. The best time to buy was yesterday, but today's just as good. It would just really be what's relevant to you. And then we do have options for folks that maybe have some health conditions. I don't want you to think that, just because you're an oral diabetic taking a medication, but your A1Cs are level and stable, and that does not make you uninsurable. So they do take an overall comprehensive look at things. So I don't know if that really answered the question, but the sweet spot would be between, in my mind, 50 and 65.
Yep, I think that's great. Is there, another question came up, is there typically, or a typical family net worth when long-term care insurance should be considered or maybe not considered?
That's a really good question. Okay, so I guess I have a little bit of a different approach on this, because yes, there's a little program out there ran by the federal government and the state governments that's called Medicaid. Mike, I venture to guess that the folks that work with you don't ever plan on being on Medicaid. Medicaid is when you have to spend down and become impoverished and you have nothing. That is different than Medicare. So I don't know if I necessarily look at the net worth per se, because quite honestly, when the crisis happens and somebody in your family needs extended care, it's an income play, because the last thing you're going to want to do is go touch an asset that's generating an income. So the idea is to find something that will generate that income without you having to erode the assets that you've built up. So I kind of answered that a little bit different than that. I don't, obviously, if you want to know the truth, if you look at a long-term care personal worksheet, it basically says if you're a single person, you need to have at least 20,000 of assets. If you're a married couple, you should have at least 40,000 of assets. I think that's ridiculously low. Unless, you know, they had a massive trust fund that was feeding them money, I don't know if that would even be enough assets, because quite frankly, it's your money, it's your income that has to pay the premium. And it's also your income that you're going to go to first, right? You're going to tap your Social Security money first. You're going to tap any other kind of income you've got that isn't going to cause you to a forced sale at a down market, things of that nature. So I think it's more of an income play. If you have the discretionary income to pay for it, it's worth putting a plan in place.
It looks like there aren't any more questions, so I'm going to go ahead and conclude the webinar.